Welcome to the Explainer, everyone. Today, we are charting a course through Carnival Corporation's Q2 2026 earnings report. And let me tell you, this is an absolutely fascinating story of corporate resilience. It's a masterclass in how a massive company navigates some seriously choppy waters and still comes out on top.
Real quick, here's our itinerary for today. We're going to cover their record-breaking quarter, how they navigated some extreme headwinds, the unprecedented cruise demand we're seeing, their fleet expansion, and finally, we'll chart out their future outlook.
All right, let's dive right into Section 1, a record-breaking quarter. Because they didn't just meet their Q2 expectations, they completely smashed them.
Boom! $6.7 billion. That is Carnival's record-breaking revenue for the second quarter. But, here's the real takeaway. This wasn't just top-line fluff. They actually delivered over 20% more to their bottom line, generating a record adjusted net income of $569 million. It's a massive operational outperformance. They literally beat their own March guidance by a staggering $100 million.
And if that wasn't enough, they also hit an all-time high of $9 billion in customer deposits. Yep, $9 billion. What makes this so incredibly impressive is that they pulled this off on flat capacity growth for the next 12 months, beating the prior year's record by over $450 million. This is just a tremendous reflection of demand momentum, and it heavily reinforces the company's exceptionally strong cash flow profile.
But of course, it wasn't all smooth sailing. That brings us to Section 2, navigating extreme headwinds.
The reality is, Carnival faced an unfavorable impact of $73 million, which shakes out to about 6 cents per share, purely from fuel prices and currency rates. They had to sail through more than a full quarter of extreme geopolitical volatility. This really impacted booking trends for their European deployments, particularly over in the Mediterranean, just given its proximity to the conflict in the Middle East. When you combine that intense geopolitical friction with skyrocketing global fuel costs, you've got a perfect recipe for severe margin pressure.
So how in the world did Carnival fight back against a nearly 30% jump in fuel prices? Well, they hyper-focused on internal efficiency. They actually managed to reduce their fuel consumption by 5.6% per available lower berth day, or ALBD. This targeted investment in continuous fuel efficiency helped them partially blunt what would have otherwise been a totally crippling 30% surge in fuel costs.
The absolutely crucial takeaway here is that management didn't panic. When those European bookings faced headwinds, they didn't just slash prices to fill up the empty cabins. Instead, as CEO Josh Weinstein pointed out, they leaned into their existing occupancy advantage. They fiercely protected their pricing integrity rather than just throwing out a discount to get people on board.
And holding that line on pricing really paid off. Let's look at Section 3, unprecedented cruise demand.
What's truly remarkable is that despite those higher prices and all the global noise we just talked about, Carnival is already 93% booked for the year. 93%! That leaves far less inventory remaining for sale right now than at this exact same time last year. Their booked position for the second half of 2026 is higher than last year, and they're holding historically high prices in constant currency.
Plus, this demand isn't just a flash in the pan. They have successfully built the furthest out booking curve in the company's entire history. Since March, booking volumes and prices for future sailings have been running well ahead of prior year levels, and that includes a substantial increase in bookings for next year's European deployments. We're seeing this demand extend powerfully into 2027 and beyond.
So, what are they doing with all this momentum? That brings us to Section 4, expanding destinations and fleet.
With all this cash flowing in, they aren't just sitting still. They are aggressively expanding the physical product. They're pouring capital right back into the guest experience. We're talking about ordering 3 massive new LNG ships for Princess Cruises and rolling out comprehensive fleet modernizations for Holland America Line and AIDA. They're also seriously upgrading their exclusive destinations. They're building a massive pier extension at Celebration Key, which has already welcomed over 2 million guests, by the way, adding a new pier at Relaxaway in Half Moon Cay, and totally transforming Mahogany Bay into the brand new Isla Tropicale. It's a huge wave of investment.
Okay, let's bring it all home with Section 5, charting the future outlook for the rest of 2026. Looking at their full-year guidance, they are projecting a net yield increase of about 3.2% in current dollars. Now, adjusted cruise costs, excluding fuel per ALBD, are expected to go up by about 3.7%, and keep in mind that does factor in over 30 basis points for those elevated logistics costs stemming from the Middle East conflict we mentioned earlier. But even with those slightly elevated logistical costs, their internal operational improvements embed some really strong net yield growth, driving an adjusted EBITDA outlook of roughly $7.11 billion.
And you know, all this incredible cash flow has significantly deleveraged their balance sheet. They've improved their net debt to adjusted EBITDA ratio down to 3.1x. That means they dropped their net debt ratio by more than half a point in just a single year. And the financial markets are absolutely paying attention. This continued momentum actually earned Carnival a credit rating upgrade from Moody's alongside a continued positive outlook.
So let's wrap this up with the big question that ties this entire explainer together. What does all this momentum actually mean for shareholders? What's the payoff for the folks backing the company?
Well, the answer is accelerated returns. Carnival has now surpassed $450 million in stock repurchases under their current buyback program. If you add that to their dividend distributions, they've returned over $400 million to shareholders year to date. That is a whole lot of value heading straight back to investors. So I'll leave you with this final thought. If Carnival can achieve these all-time records, record revenues, record customer deposits, and record adjusted net income, while literally sailing against extreme geopolitical headwinds and a 30% surge in fuel prices, what in the world is this powerhouse going to accomplish when the waters finally calm down? Thanks for joining me for this explainer, and I'll catch you next time.